Brendan Barnes here. I'm interviewing Gerald Stack, Head of Infrastructure for Magellan. Just want to give you an understanding that our investment philosophy in Barneswealth management is to produce a reasonable return with less volatility over the longer term, and we run our own portfolios. So welcome, Gerald.
Thanks, Brendan. Yeah.
Look, anything you would like to tell us first up?
Let's talk a little bit about how we think about the world and what we're trying to achieve. Infrastructure is quite different to global equities. It's a low volatility area of the global equities universe. So it's certainly not get rich quick, but it's about growing wealth with a high degree of confidence over time. And the essence of what we're trying to do for your clients is to make sure that we deliver very reliable returns over the long run. And we do that by focusing on what is a conservative world, infrastructure. Infrastructure are companies that provide services that are essential for the efficient functioning of communities. They're services really that people can't live without in their day-to-day world. It's the provision of energy, the provision of transport, the provision of water. So these are services you really need for you to get through the day. And they're typically done in a monopoly construct. So you've got an essential service provided by a monopoly. And because it's a monopoly, typically they're regulated by government. Regulation is there to protect the consumer. Otherwise, if you've got a monopoly provider of an essential service, they'll put up the price until it, starts bleeding. So the essence of this is these things are typically regulated. And indeed, if they're not regulated, we probably question whether they're infrastructure, because if there's not regulated, it tells you there's competition. If there's competition, then there's pressure on earnings over the long run. Competition's a wonderful thing for consumers. I love competition as a consumer, and I hate it as an investor. As an investor, it means that there's some threat to my returns over the long run. So the nature of what we're investing is essential services in a monopoly construct, typically regulated, and the regulation allows you to earn a fair return on your capital. And a fair return generally is struck in terms of inflation plus about 5% return. That's sort of what people should expect over the long run. And these companies should be providing you with very reliable service over time to their customers, and they should be generating, as a result, very reliable investment earnings over time. In the short run, the investment markets are often a bit of a popularity contest, and infrastructure and utilities rarely win that popularity contest in the short run. But they are the ultimate turtle or tortoise in the race versus the hare. They just keep plodding away, and lo and behold, when you look up 5 years down the track, they've provided you very reliable returns over that time, very reliable earnings, very reliable returns, and that's what ultimately you deliver to investors. So the essence of what we're trying to do for all our clients, for your clients as well, Brendan, is to find this portfolio of companies that are providers of infrastructure services, they're providing very reliable earnings, and those reliable earnings over time give us confidence that we'll deliver those very reliable returns. Does that make sense?
Yeah, no, it's good. Thanks very much for that. Seems logical in the most simplest way, but obviously there's a lot of research and process that's required in that.
Absolutely.
I suppose another question I've got is, typically, what is the sort of number of companies and sort of where are you investing their clients' money or clients' money as a whole?
So with the way that we start this process is by we look at all the different indices and all the different companies that various people call infrastructure. And there's about 350 of those. So globally, these are companies listed on the stock exchanges. There's about 350 companies that various investors would think of as infrastructure. And then we apply our definition to that. And our definition is that 75% of your earnings have either got to be regulated if you're a utility, or they've got to come from transport infrastructure assets, your toll roads, airports and the like. So 75% of your earnings have to come from things that we're very confident will deliver those very reliable returns over time. Now, applying that test reduces that universe from 350 companies down to about 140 companies today. And it's in that universe of 140 companies that we're particularly playing. And we're normally selecting a portfolio of approximately 30 companies. At the moment, it's 28 companies in the portfolio. Okay. And over the last 5 years, it's been as many as 35. But 30 is the sort of roughly where we expect to be. And we can be anywhere in that universe. Our universe is roughly 60% utilities and 40% infrastructure. So infrastructure is transport of people, data and goods. So it's toll roads, airports, energy pipelines, communications infrastructure assets, rail. So they're the different infrastructure assets. So it's roughly 60% utilities and 40% in that infrastructure bucket. Now, where are we today? We're roughly 50-50. We're about roughly 50% in the utility space and about a little over 50% in the infrastructure space. So we're, compared to our potential opportunity set, we're slightly overweight infrastructure, we're slightly underweight utilities. And the reasons for that is, if we think about utilities, as I mentioned before, they're regulated. And so we know what they're going to earn. And typically around the world, a regulated utility, someone who transports electricity through the poles and wires into your house or transports water to you or gas to you, they earn around about a 9% return on your equity. So that's what they should earn. And that regulation's transparent and clear, so you know roughly what you're going to get. So we expect to get 9%. They'll trade up and down, so that 9%, if they trade more than the net asset value, that 9% becomes, say, 8% or 7%. But it's a very reliable return over time. And if you like, in yachting parlance, that is the lead in the keel. That's the ballast in our return. In the infrastructure part of our universe, it's price that gets regulated rather than earnings. So if you think about a toll on a toll road, that toll grows with inflation as inflation comes through. And that's the contract that the company, Transurban in Australia, for example, has with the government, that they'll put the price up no more than inflation. Generally, they're going to put it up at inflation as soon as the inflation number comes. Yeah. They're going to put it up no more than inflation over the length of the concession. So that's price that gets regulated. And therefore, if we can identify assets in that space where volume, traffic on a road, passengers through an airport, data through a communications network, where that volume is going to grow in a structural manner, and in other words, we've got confidence it's going to grow over the long term, then what that enables us to identify as assets who can earn a high and a growing return on capital over time. So we tend to find those companies as being more attractive to us rather than utilities, and hence we're slightly overweight infrastructure and slightly underweight utilities compared to our universe. So that's where we're at in terms of the sectors. If we then think about geographies, today we're around about 50% in the US. We've got less than 5% in non-OECD jurisdictions, so in emerging markets. We've got about 2% in emerging markets. And that's, really over the last decade, we've typically had less than 5% in emerging markets. So it's very much a developed market play. It's about that reliability of return. As I said, at the moment, about 50% in the US, probably more in the US at the moment than we've had for probably for the last decade. So we've sought out opportunities there. So as I said, roughly 50% there, around about 10% in Australia, around about the remaining 40% really in Europe. And of that 40%, the bulk, let's say 30%, 3/4 of the 40% sits in Western Europe, with about 10% in the UK. So they're the three major sort of fields, if you like, of operation: US, Europe, Australia.
Okay, so that was very comprehensive. Thanks very much. So with regards to summarising how Magellan Infrastructure Fund really protects our client's money, or any client's money of yours, and what sort of volatility you expect for your over the longer term, your fund.
Yep. So the first thing, the way that we're seeking to protect people's money is through definition. So if we define our world tightly of infrastructure, then these are companies that really collectively, it's very difficult to see that too much will go wrong. You can have pandemics that will throw you off the scent for a little period. We've seen what happened to airports through the pandemic, but those airports are coming back to trend pretty quickly. Passenger numbers globally are now at around about 80 to 85% of where they were back in 2019. And in jurisdictions like the US and Europe, we're seeing passenger numbers back at around about 90% of where they were. So quite quickly, those passengers numbers are coming back, and we think they've got quite an optimistic outlook as we move forward. So there's something that, in the short run, it had something of an issue, but in the long run, the fundamental service that it delivers is essential to the efficient functioning of their communities. And therefore, that gives us a very strong sense of reliability about the returns that we're going to get. So by defining the world in those terms, 75% of earnings must come from either regulated utilities or transport infrastructure assets. That's the first way that we're seeking to protect people's capital. The second thing that we're doing is we're doing extensive valuation analysis and strategic analysis of each of these companies to make sure there's no single threat that that is going to pose an existential risk to any of these companies, and that includes these days, in particular, the transition to net zero. There are a bunch of companies out there who face all sorts of challenges as we move forward on as a result of the reduction in carbon emissions that is going to be required to get the world to something at net zero or something approaching net zero. So there's a lot of work that goes into that, and that plays into our valuation analysis. We're valuing everything that we do over the life of these companies, trying to make an assessment about where the best opportunities are. So we've got definition. We're then seeking to find those things that we think are trading at a material discount to our assessed value, and they're the companies that we're going to invest in. And in the short run, that doesn't mean there won't be volatility in share prices, but in the long run, if the earnings present as we expect, those reliable earnings, and ultimately share price will follow those earnings. So it's the earnings ultimately that lead to us protecting people's capital. The sort of level of volatility that we've seen historically is, if you think about market beta, the market has a beta of 1. The beta of our funds typically been about 0.6, 0.5 to 0.6 in that range. So what that means is that in up markets, if markets are rising, we're not going to do as well as the broader equity market. But when markets are falling, we expect to do much better. So structurally, when markets are falling, we expect to be the ballast in people's portfolios to provide very reliable returns. But when markets are rising, we'll do okay, but we're not going to do nearly as well. We'll do 60% of the market typically when markets are rising, but we're only going to do 60% of the market when it's falling as well. So it's when markets are falling or going sideways that infrastructure tends to provide very reliable, non-volatile returns.
So that's really good. I didn't really know that. That's fantastic. With respect to, you talked a lot about the process. What about the process in your people, in your organisation, in your infrastructure team?
Yeah, so if you think about it from the day that they get recruited into, and how their careers progress, within our infrastructure team, there are 8 people who are involved. I've been here for 15 and a half years since Magellan started, and we've just progressively built the team over time. And so, as I said, roughly 8 people today. We started with sort of essentially 3 of us, and we've built the team as the business has been grown over time. So when they come in, what we're looking for is people who, like all firms, we want people who are smart, but we're particularly after people who are really fundamentally interested and fascinated by investment. We want people who are going to make their hobby their job. Right. And so far that's worked kind of well. We've never the team that we've got, none of them have ever left. They've always we've had very low turnover in our team over time.
Sounds like a good culture.
Well, hopefully, ultimately we understand that we will lose people over time. That's inevitable. We can't provide the opportunity to everyone that we would like to necessarily. There are only so many people who actually can be portfolio managers in the team. But what we're seeking to do is make sure that we develop them as much as possible through time. And our team, we act as one. We have 5 portfolio managers and 3 analysts in the team. All the portfolio managers cover stocks, so we all cover companies. We're all analysts at our most basic level, and then we have a bunch of the team, including myself, who are also responsible for managing portfolios. And we're looking for all of the team to get involved every day in pushing ideas forward and presenting their perspectives. They're smart people, and we want to get the best out of them. So, we've had a good track record with our team over time. We're really pleased with the nature of the team. We work well together, but we don't take it for granted either.
So I suppose another question would be, with our clients, how easy it is for them to get their money should they wish to withdraw, and therefore, how secure is the capital, I suppose?
Yeah. So we're investing in listed securities. So we'll get inflows and outflows every day. So your clients can get their money out on the day. They can once they submit a redemption request, that'll be traded on automatically. So they have daily liquidity, and so obviously it's one of the benefits of investing in listed securities is you have that daily liquidity. So they should have no concerns about the protection of their capital over the long run. If they don't like what we're doing, they can take their money out at a moment's notice. And we don't take that for granted. We understand that it's a privilege to manage money for all of your clients, and we know that they can take their money out if we don't do the right thing by them.
Fantastic again. Look, I suppose another question would be research that organisations do on your investments and your philosophy. I did my research, as you expect. A couple of the investment houses had you highly rated. Tell me about that process and what sort of credibility for investors should use with getting the highest rating, really, in the market.
Yeah, so there, as you say, there are a number of research houses, and they will come in and meet with us once or twice a year, and they've been doing so for 15 years. Perhaps in the early years, they met with us a little bit more often, but they've come to know us pretty well over time. If we're doing anything, if we're making any changes to what we're doing, we'll talk to them about it. So there's an ongoing in-depth due diligence process, if you like, just as I talked about. We do valuation analysis of our companies, and that's part of our due diligence process into companies. They do the same thing to us. They come in and look at our process, quiz us about it, try to make sure that we're making rational, logical decisions in a replicable manner, that we're looking after the team and developing them over time, that they have trust in us as a house and as a team, and that's an ongoing process. We've had a good relationship with most of those guys over time. We don't always get what we want from them, but they ask us lots of questions. It's as you'd expect, that they put us through a rigorous process, and we have to show our the worth of what we're doing over that time. So that's for the bulk of those research houses. That's a relationship that's been going essentially for 15 years.
So I suppose in client speak is that they now understand that you're also getting audited to make sure you work towards your philosophy, you don't take on additional risk, you're true to your label and your style.
Yeah,
so most people don't know that. So
we're very conscious of our label, and our label revolves around that definition of infrastructure. And if you like, one of the ways I try to describe that to people is if my universe that I invest in, infrastructure companies, are generally pretty boring companies. They're producing returns, earnings that are very reliable, predictable, almost boring manner. And if I've got too much excitement in my work life, it probably means that I got the definition of infrastructure wrong along the way. Now, 2020 and 21, we had a bit of excitement, and frankly, that's enough excitement for me for quite some time. I don't want that excitement again. So the essence of what we're doing is trying to make sure that if there's companies that are a little bit exciting, they probably, do they actually meet our criteria? And so, if they're getting more than 25% of their earnings from emerging markets, where for particular emerging markets like China or Russia, then we're going to avoid them. Jurisdictions where we're not comfortable with the sovereign risk. If more than 25% of their earnings are influenced by competition, like power generation, we don't want to be there. The power in Australia, the price of electricity is around about $90 a megawatt hour, but it fluctuates anywhere between about negative $500 a megawatt hour and about $14,000 a megawatt hour. Wow. So as a result, if you're investing in power generation, in a merchant power generation or a competitive power generation rather than regulated generation, then you've got revenues that are just not reliable and predictable. It doesn't make them bad companies or indeed bad investments, but it means they don't have that reliability that we look for. So we don't want competition, we don't want sovereign risk, we don't want commodity price influences. So if the oil price rises and falls and that influences your earnings, then it won't be in our universe. So we avoid all of those things. As I said, we're stripping out anything that's a little bit interesting. We're trying to focus on making sure earnings are reliable, predictable, and as I say, hopefully boring.
Del, that just quite a bit of knowledge that you put forward to us. Thank you very much. Great philosophy. Really, it's a lot similar to what we do. The approach is definitely about a reasonable return, less volatility, and protecting clients' money. Very, very good. Thank you very much.
Thanks very much, Brendan. That's exactly the essence of what we're seeking to achieve.